If you're looking at the entire daily range, you're going to use the opening price at midnight. But if you're going to be looking at the morning session, you're going to be looking at the 8:30 in the morning opening price. Okay, so hopefully that's made a distinction there. So 8:30 in the morning, that opening price, I'm bearish. I'm thinking we're going to go down below that green level there. That's the old daily low. So on this candle here at 8:30, I'm expecting all this being a fake rally. It's something to lull in traders to chase it going higher. The retracement, people that don't really understand order blocks, they're going to say, look at that, it's a down closed candle. I'm going to buy that. And then when it starts to go up like that, they feel, wow, this is really easy. Every down closed candle after a run up is a bullish order block. It's not. In here is the real context. Okay, we have an imbalance there. And that's what I'm looking at. I'm looking at this imbalance right there. So I'm trying to operate inside of that range for a short. Now, I know because of the volatility, it can color outside the lines, and it's okay. The bodies of the candles are kind of supporting the idea of what I'm looking for, but the wicks I could care less about because I want to get in when it's ideal. And I'm going to show you what that was looking like for me at the time. So we're going to drop down into a 4-minute chart. Okay, so here is that imbalance and fair value gap on the 5-minute chart, but now it's a little skewed because it takes up 2 candles to show that range. The market trades up, and right in that candle, that one right there, that's where I'm going short. I got in at 10:33. Okay, that was my short. Dropping down into a 3-minute chart. Okay, the market trades up, works inside that imbalance, and right there, 10:33, that candle, when it's starting to bump up against the top end of that fair value gap, right there, as it hits that and starts to move away, I'm in there. I'm going short right there. The reason why I'm trusting that and not thinking it's going to go higher is because we have this high here, okay, and then we have this high here. Which high is higher? This one or that one? Obviously this one. Now, this candle's high. Watch what happens. From this high, we have a short-term swing high next to it here, and then we have one here. So this one makes a intermediate term high. So we have a long-term intraday on a 3-minute chart, which sounds like an oxymoron, I know, but long-term high, intermediate term high, because this high is lower than that one. But we have a swing high here and here that are lower, both being lower than this one. Then we have the same context right here. We have a high with a lower high on either side of it. So I have market structure behind me showing that this is, number one, it's a bearish market because my draw and liquidity is down here. It hasn't traded down there yet. Okay, so it's going to act like a big magnet. So all these fluctuations in here, without understanding what I'm showing you, it's going to feel like it's just noise. It's chop. It's not. It's actually telling you exactly what it's going to do. So the swing high here is an intermediate term swing high. So I want to be going short real close to this high because it's likely to break like it does here. So at 10:33, when it hits the upper end of that fair value gap, I have at this moment, go back one candle. We have this high, a higher high, and a lower high. So we have a high with a lower high on either side of it. That's a swing high. That is lower than this one. That is lower than that one. So it's far more than just, oh, he's just looking at lower lows, lower highs. That's what a myopic individual would come and watch this. So like when they see me put a rectangle on the chart, they're saying, oh, it's supply and demand. It's not. There's so many more factors involved that it's just not even in the same vicinity. Okay, so sparing all that, compare and contrast, because I've done a lot of that already on the videos on this YouTube channel. So what you're doing is you're looking at all the swing highs. And every time you see a swing high, and a swing high is simply a high that has a lower high candle to the left of it and a lower high candle to the right of it. And the one in the middle, that's your swing high. Note that. Okay, in the old days, when we printed out our charts and such, and we had chart books delivered to us, we would get them once a week. They would give us the Friday's closing data and all the daily candles. And then until we got our new updated chart book, we had to hand draw in the open, high, low, and close on the charts, on the markets that we were following. So whenever we saw a swing high or swing low, we would just put a little ring above it, little circle, okay, like a little halo. And that would be a short-term high. Now, I would do a double circle or double halo for an intermediate term high, and then 3 halos for a long-term swing high. So that way, when I'm looking at price, it allows me to classify the level of high that it is forming. So it's not just lower low, lower high. No, you got to look at the nesting effect of the highs and lows. But if this is the candle I'm trying to get in at, and I execute on, with all the understanding I just outlined there, I want to see displacement. We get it here. Now, if I didn't take this trade here, I could trade with the return back to this right here. Why? Why is that possible? We have a swing high. It's broken to the upside. This low is taken out here. This candle's high here. If it touches that again, I can be short there. Just using the imbalance in the fair value gap entry technique I'm teaching you. So I can go there and get short, or I want to get up here as close as I can to that important high that I've already outlined here. So I want to be in that and wait for that initial move, because then when this occurs, when you're that high up in the session high. So at 8:30, right there, this run up, I'm real close to this high by entering there. Notice that? I'm not waiting for a breakout below that low. So I'm getting up in there where it's an optimal entry. I don't need to get the highest high. You don't need to get the highest high. But you need to understand why it should be trading away from the levels you're trying to enter at. And that's kind of like what I'm showing you here. So this morning, after 9:30, again, what's the bias? Bearish. That has not changed. Even though we had this run up, it hasn't changed. So at 9:30, equities open. After consolidation, it runs up, creates a high, and then runs up again, takes out the high. That right there is your run on stops. Wait to see if it wants to break down. It does. So we're going to look at that and refer back to the video. I just put a little short video up this morning and outlined the whole business there. I don't want to do it here because it's just rehashing what I already showed in a very short 1 minute or so video. But ultimately, right in here, we have a nice little selling opportunity, and you can attack the fair value gap in here between the low and the high. Right there it would be. And if you want to trade with the longer term bias, you can attack the sell side liquidity resting below here and here because they're relative equal lows. And then you would have got a nice fill there as well. So I teach in a manner that allows my students to pick, number one, the style of trader they want to be. They want to be a day trader. They want to be a scalper. They want to be an intraday swing trader. If they want to be a short-term trader where you're holding over to, overnight, or if you want to be a daily chart swing trader or 4-hour chart swing trader where you're holding for a week or more, or if you want to do a position trader, which to me is I don't have that mentality to do that. I have too many things that show up on a chart that make me change my mind all the time. So we're going to drop down into a 15-minute time frame. So that same old low level down here, and that high I just mentioned on the hourly chart and the low on the hourly chart is now been defined with a small little line segment. Okay, so we have a trend line here and a trend line here. That's the extent of a trend line. That's it. I only use them to highlight to my students. These levels are not on my chart. I'm watching a naked chart. Okay. You, while you're developing, you should have these levels drawn out on your chart because it helps you build and ingrain the idea that this is where liquidity is. It keeps you focused on that. because it's easy to look at all these candles forming if you have the luxury of watching it in live, and you can lose sight of where you are. And once you lose your bearings, it's really confusing. And this helps you keep those bearings in mind. And what do I mean by that? Well, I mentioned how the market dropped down initially, and that takes the sell stops out. So sell side liquidity has been attacked. Traders are now tripped in going short if they sold on a break, trying to be a breakout artist. And then the algorithms go right back up to an area where it's been cleanly delivered relative equal highs. See how this high here, right before it dropped, is basically the same high here. Notice that? So retail traders see this and they trust it as what? Resistance. So the books always say, put your buy stop, if you're going to go short, right above a clear level of resistance. Well, these levels work for a short period of time, but majority of the time, you see this event right here. And this is how I teach my students to go in there and look for those types of events. Because what did I just tell you moments ago about looking for significant price moves? Before there's a significant price move of any real magnitude or importance, generally there's going to be a stop hunt that takes place right before that price delivery occurs. So what does it look like? You have relative equal highs, this high and this high. The market goes up when we're what? We're expecting lower prices on that weekly chart. We're on the last day of the week. It's already been heavy. It's weak. And the only thing it's been doing is consolidate. And the first thing it did was broke out to the downside, tripping what? Traders in a breakout to go short. So now they have traders caught on the wrong side, offside, and now they want to take the market up here, where those buy stops are going to be resting for those that were smart enough to sell short here or here and didn't get out below here. So the larger pool of liquidity is going to be resting here because it's in sync with the downtrend, and everybody that was short the day before, they seen this high form, and once it broke below this low here, they all rushed and trailed their stop loss right above that. And I understand if you're new and you think, well, this is easy to explain in hindsight, but I want to remind you, go back and look at the first slide I showed you. Those were actual entries. That's a live account through Thinkorswim. Charles Schwab, that was the clearing firm that did the brokers side of the business, okay? So I'm not showing you a demo account. I'm not showing you paper trading. Those were real entries, okay? They were real reversals, the whole business. But the main thing was I showed you that larger trade. This is going to be the framework that I'm teaching you how to find it, okay? But this pool of liquidity, once this occurs, you want to drop down to your lower time frames and start looking for something specific. And let's go into those lower time frames and find out what that is. Okay, here's a 2-minute chart. Why a 2-minute chart? Well, 2 minute, 1 minute, or 3 minute, or 5. 5 minutes still has a lot of room for imbalances to occur underneath that time frame. And what do I mean by that? The 1 minute, 2 minute, 3 minute chart tends to be the best for finding the imbalances for indices. Okay, don't take my word for that. Okay, if you're looking for high frequency setups intraday, the 1, 2, or 3 minute chart are just beautiful. They just offer a real good clarity. The reason why, because the high frequency trading algorithms are operating on nothing really higher than 3 minutes. But majority of the time, they're like seconds, okay? 15 second, 30 second, 45 second, 60 second intervals, okay? And what they're looking for are these small little imbalances. And what does that look like? Well, we have that run on the buy stops here, okay? Remember that old high here, the old high here, old high here. It runs right on through that. Once this occurs on that higher time frame, 15-minute time frame, you want to drop down to the lower time frames. And I'm using the 2-minute chart because this is exactly what I was using to find that imbalance and trade off of it, okay? The market creates a short-term low here, and then it breaks below that. This is key. This is called a break in market structure. Now, the foundations and underlying framework is we're in a market that's what? Weekly bearish. We're expecting that weekly candle to expand lower. It's been expanding all week. So we have momentum on our side. We have a consolidation that's occurred, and we had a pool of liquidity engineered with these relative equal highs, and the market broke out to the downside first, and then they ran on the highs. So once it went here, we don't rush in there, just go short because it went above the old highs. We're looking for some specific signature that tips its hand to you, okay? And I promise you, when you start going through your charts, and it's going to be homework for you, you're going to see this occurring almost every single day. And if it's not doing it this way, it's doing it the opposite direction as a buy. Okay? Again, don't take my word for it. You're going to be flabbergasted. You like that? Flabbergasted when you see how many times this thing forms every single week. Okay? It's many times throughout the intraday charts it creates this type of move. But it runs the stops, then we have a short-term low, and then it breaks below it. So now we have a break in market structure. Okay? Once this low is broken, you're going to look for this little area here. That's that imbalance I mentioned in the beginning, right? So what's happening is the market's going to go right up inside that area there, and that's where you want to sell. Now, if you don't sell there, you can drop down to a lower time frame, 1 minute chart. If this was a 3-minute chart, you can go down to a 1 minute chart and look for that to occur on that time frame as well. And it many times will form if you're looking at a lower time frame, like say this was a 5-minute chart, and you looked at a 1 minute chart, you'd find one down in here. It's a matter of scaling down in your time frames, because once you have an underlying premise to the market now likely to go lower, it becomes an easy thing to look for these types of things. So in your chart, once you're developing this idea and learning it, you're going to highlight this candle's low, this candle's high, and this right here is what I teach my students as a fair value gap. Okay, you don't have those in books. Okay, you don't have any of that kind of stuff out there. It's something I introduced back in 2016, and obviously a lot of people discovered how good it is, and they try to make courses with it. But I'm gonna not touch that right here. But the idea is once it go up into that imbalance there, and once it does that, as soon as it enters that area, the algorithm that delivers price. Now, some of you may not know what that means, and some of you may not even agree with it. You may think that this is made up or it's contrived. I promise you, if you spend time with this, you're going to quickly come to the conclusion that there absolutely is an algorithm, and it's manipulating the markets every single day, every single tick. It's completely controlled, okay, period. You're led to believe it's buying and selling pressure. Now, if I go back and use that analogy where it went down here first, then go up here, some of you may argue, see, that's the buying and selling pressure. No, it's not. It's liquidity. Now, you may argue and say, well, we're arguing semantics. No, I'm telling you what's going on. This is the logic. This is how these markets book, okay? Once you see these patterns over and over and over again, it's very easy to execute on them. But the impulse to want to do it the first time you see it because you've watched this video, that is going to be problematic for you. So you're going to have to do a certain number of weeks and months of back testing. There's no escaping that. You have to do it. Any skill set, any teacher, educator, system, whatever, okay, whatever they're going to give you, there's going to be some kind of growing period where you have to trial and error, fix the problems that you have about yourself. And I've literally taken your attention to a very specific framework and setup. Notice that? Some of you may think I'm still talking too much, but I'm taking you right into the heart of the matter. This is what it looks like. This is what you're looking for, okay? These are the fingerprints of that setup. But focus on the imbalance after the market structure breaks. So this big candle here, it breaks down. Look at the next candle. It opens and trades higher and stops right there. So from this candle's low and this candle's high, when this candle starts trading, as soon as it opens and it runs right up into that, that's a short. You can go right in there, sell short, be done. Now, where's your stop going to be? Well, you can put it above this high here, or you can put it above this candle's high, whichever your risk parameters allow for, okay? If you're trading the micro, which is, again, it's not a lot of money per tick, so the multiplier for that is very, very small. If you trade the larger full futures contract, and if it moves 100 points, and they can do it real quick, it can burn you pretty bad. So you may have the leverage to trade with a discount broker. Okay, you may have the initial margin to trade with a discount broker, but you may not have the wherewithal and the skill set to navigate this market. And that's the only thing I'm trying to provide here as an alternative, because there's a lot of individuals out there that will promote the idea that you can go out there with a discount broker and just clean up. Yeah, if you know what you're doing. But you don't need a discount broker to be profitable. Okay? Looking at this further, we're going to look at the logic in here. And I want you to think about after this forms and you see that as your choice setup or entry. If it starts to move lower, you can still get in it. There's no reason not to think that you can't get in it here or in here. It's close to or in close proximity to where that area is as an entry. Once we take out a low, though, once that occurs, then it becomes a matter of your chasing price. And if you try to get in, especially if you like use a market order, you may see it trade right to this low and say, okay, now I believe it's going to go down. You put a market order and sell short, and then slippage gets you down here. And it creates a larger area of risk that you have to assume, and it's problematic. You want to learn to trust going short when the market's going higher, and that feels scary at first. But once you start seeing this pattern form, it becomes easy to trust it.